Hello, and welcome to Treasury Strategies webinar on the impact of Basel III on deposits. I'm Kathy Gregg, a partner with Treasury Strategies, and I'm joined here on this frigid day in Chicago by Dave Robertson, also a partner of Treasury Strategies and the head of our financial institutions practice. We have 45 minutes with you today. And we'd like to spend the first 30 minutes of that going through our prepared material and then reserve 15 minutes at the end for questions and answers. And I'll get to the Q&A in a second. But let me just briefly review the agenda that we have here. We're first going to begin with an overview of the deposit regulation and the implementation status of it. We'll dissect the regulation a little bit. And of course, since we're focusing on the deposit part of it, we're not going over the whole Basel III regulation, but the part that speaks specifically to deposits. We'll dissect it somewhat and look at the components. We'll talk next about some thoughts about preparing for implementing the deposit-related part of the regulation, getting your plan together, and some feedback we have about where the marketplace stands with its level of readiness. And then, as I said, we'll take time for Q&A. Now, we'd like to take your Q&A through the webinar service. So in the bottom right-hand corner of your screen, you'll see either a question and answer box, or if you haven't got that pulled up, then click on the question icon, the question mark icon, and you'll be able to type and enter your question at any time during the webinar. So feel free whenever your questions come up to put them in, and then we'll deal with them in the last 15 minutes we have allocated. Also want to let you all know that everyone who registered for the webinar within 2 days after will receive a link to the recording of the audio portion of the webinar, as well as a copy of the deck that we're using. And if we don't get a chance to answer all of your questions, we will do that in writing, and we'll send them all out to all of the registrants as well at the end. Okay, so I think that's it for our logistics. Let's get started. So we are now at the, I think, welcome stage of having the local regulatory jurisdictions beginning to give us their input as to how they're going to interpret and operationalize the Basel III rules. For example, we've just had a notice of proposed rulemaking come in the U.S. from the OCC at the end of November about how they're going to be looking at the LCR, how they're going to be interpreting that and the standards they're setting for that. And that means it's a good time to be taking a look at how these rules are likely to affect the deposit business. Once we've got this little bit more certainty to it, we've actually got something to sink our teeth into and work with. Normally what you see when a major rulemaking like this is given is, first of all, the banks that are affected by it are going to spend a little bit of time making sense of whatever it is they've now got to digest. And then depending on the nature of their business, their strategies, their portfolios, et cetera, they will develop response strategies for those new guidelines. So as those strategies go out into the marketplace, we have a first sort of chaotic period of time where there are initial reactions to the new strategies. Some banks will be leaders, some will be laggards, some will not be taking action at all immediately. You have this period of rapid, chaotic adjustment. There will also be secondary levels of adjustment as the marketplace responds. Maybe some players will be making secondary level of adjustments as they see how their competitors have set their strategies, et cetera. And we have a whole layer of non-bank players in this as well. So there are going to be substitute products like direct money market instruments and mutual funds, non-banks as part of the mix, and we have to see how they respond and how corporates turn to them as part of their response to the bank strategies. Ultimately, you reach a point where the market has digested these changes and we've come to a new equilibrium. So the thought process that we have is the sooner you can get your business to that new equilibrium, the better off you are in terms of sustaining your current book of business and positioning yourself to grow more rapidly under the new regulatory regime. And given that this is probably the most significant change ever to hit business deposits in banking, it's a very important time to be taking a look at how these regulations are going to affect us and what your strategies ought to be. Dave.
Thanks, Kathy. So what I'm going to do now is I'm going to go through an overview of some of the major components of Basel III as it applies to deposits, and then we'll talk through the timeline and some of the interpretation of operational deposits. There's going to be a significant regulatory focus on liquidity. It really goes beyond Basel III. We do see the regulators, when they are looking at our clients, taking a much more strenuous view of how are the banks managing liquidity. Are they appropriately signing the economic costs of liquidity and modeling liquidity risk? As a result, banks are going to have to make business decisions that institutionalize the risk costs of liquidity into their business decisions and pricing. And I think we're at a fairly immature stage of that in the market. Probably one of the most notable sections of Basel III is the minimum liquidity coverage ratio, and that's based on a modeled runoff of both tangible and contingent assets and liabilities. And depending on the size and complexity of your bank, that's either a 21-day horizon or a 30-day horizon. And one of the reasons we've broken out assets and liabilities as tangible and contingent is it's not just the stuff on the balance sheet that has to be modeled. Anything that has any kind of optionality has to be evaluated during the runoff scenario. So for example, loan commitments can be drawn upon, and deposit products that do have the option for the client to exit the deposit could be exited as well if that's the optionality of the deposit. In addition to the liquidity coverage ratio, there's the net stable funding ratio, NSFR, and that's really intended to capture more of a midterm view of liquidity, and we are going to see more prescriptive clarity on that in the months ahead. But for now, what we do have is some emerging regulatory guidance on the liquidity coverage ratio, and we're going to share with you what we're seeing, what we see as the main points of interpretation, and what are the key business and strategic decisions that need to be teed up in anticipation of this going live. So one of the things that's most critical is that the liquidity coverage ratio requires you to place your deposits into runoff buckets based on the type of the deposit, the market segment of the deposit, the term of the deposit, and even the underlying behavior. And what that is effectively doing is it's discriminating deposits based on their value in terms of providing liquidity to the bank. And obviously that's going to have a huge economic impact on the bank. If you have too many illiquid deposits, you're going to have to compensate on the asset side by not underwriting a lot of loan commitments and by holding very low yield, high liquidity assets to offset these volatile deposits. So as you can see, we're going to see kind of almost a binary impact where some deposits become extremely attractive and others become destructive to shareholder value. So right off the bat, there's some discrimination made by segments. Retail and small business are seen as the most attractive, and FI-based deposits are seen as the least attractive. Things like secured deposits are seen almost as an offset to the asset, so I like to think of them almost as empty calories on a bank's balance sheet. And then you get into some of the nuances of this regulation, and I think one of the things that's most challenging for bankers is there's a lot of interpretation that still, beyond this guidance, needs to take place. For example, term deposits must have a significant cost for early withdrawal, and they can't mature within the stress scenario. So for example, a 45-day term deposit might look great at the beginning of a scenario, but on day 15, that's going to become a runoff deposit for the bank. And as a result, you're going to see banks changing their product structure. We are already seeing things like the perpetual callable term deposits where their customer has a 31-day call option. So in essence, until the customer calls the deposit, it qualifies within the liquidity coverage ratio as a term deposit. We're also seeing behavior as a critical element, And it's fascinating to us. Banks are going to have a much better empirical basis for, first of all, noting that their deposits are the result of a customer's operating activities, and secondarily, that there's not significant volatility. And again, that's another thing that has to be interpreted. What does significant mean? In our work, both with Treasury ALM and the business units, we find that the commercial deposit modeling techniques of banks are very immature. They tend to often be based on retail deposit modeling techniques that are very inadequate in describing the behavior of commercial deposits. And not to get into too much detail, but you get into threshold impacts, collinearity of variables, and a much different response to macroeconomic changes, both within the non-financial companies and the financial companies, that really aren't captured by these legacy models that banks have been using. So what you have is you essentially have the assessment of the deposits, which is still unclear. It's going to challenge bank data systems as to how they've classified deposits. It's going to challenge banks' data systems to get at the underlying cash flows and the data needed to assess the volatility. And it's also going to challenge the analytics. And it's not that far around the corner, so there's a lot of preparatory work that has to be done. On top of simply assessing the deposits, there's going to be a ton of work that has to be done in response, because one of the first things that you will see as a bank, once you model the liquidity coverage ratio, you're going to see some deposits that are incredibly attractive and others that are going to have a much lower value placed on them. And in response, we're already seeing some banks begin to introduce new products, new market strategies, even new contracts. Do you need to change your contract language to comply with some of the rules that we'll get into later? And lastly, the analytics and the MIS. And this is fascinating because this is sort of an area where the business unit and Treasury, ALM, and finance need to work together. And what we're finding is not all banks really have knit those three units together closely enough yet. And on top of all this, the interpretations of Basel III vary by regulatory jurisdiction. And my heart goes out to those banks that are operating in multiple jurisdictions, because basically every home regulator wants everything their way, and what you're left with is basically a multivariate equation that's unsolvable. So, you know, all of the global scale that banks would love to have in terms of managing their deposit books is going to be very difficult to pull off with the need to deploy multiple and overlapping frameworks by jurisdiction. So if that wasn't bad enough, we decided to accelerate the timeline for the liquidity coverage ratio, basically pushed up by a year. And so, for example, in the U.S., the Fed's notice of proposed rulemaking required banks to hit an 80% ratio by January 1st, 2015. And what that means is that the high-quality liquid assets divided by the net cash outflow over the scenario period, 30 or 21 days, has to be 80% or has to be over 80%. And then banks have to hit 90% by January 1st, 2016, and then the full 100% by January 1st, 2017. Now, if a bank fails to hit that for one day, it's not like the regulators are going to come in and shoot you, but there are definitely greater regulatory scrutiny if banks have multiple days, and there's actually a formal process if a bank has 3 days in a row where it is outside of the ratio. So one of the interesting things here is just what is an operational deposit? What is a deposit that is going to be stable versus one that is going to have a high runoff rate? And we didn't go into the runoff buckets. There's a lot of data on that on the web. But essentially the difference between an operational deposit and a non-operational deposit is a massively lower runoff rate as you get into the commercial deposit portfolio. And I just want to cover these 8 rules, and we'll highlight later on where we see most of the interpretation that remains. So the first is around the term. There's got to be significant breakage costs, and that's an open issue. What is significant? How do you really prove that a cost is significant enough to preclude a majority of the customers from breaking that term deposit during a stress scenario? And as you think about these stress scenarios, there's obviously the regulatory mandated stress scenarios, but the regulators are also looking for banks to come up with their own stress scenarios. And that really ought to be based on a bank's assessment of its own risks, its customer portfolio, and the funding environment in which it exists. Volatility. The deposit cannot exhibit significant volatility. Again, what is significant? That's a very technical term in statistics, but this looks to be more of a judgment around how much volatility can a bank take on and still have stability of funding. The deposit type. The deposit must be an operating account. And I mean, this raises both sort of existential and trivial questions. Do you need to rename your products to make it clear that this is an operational deposit? And we actually find in some jurisdictions that there are deposits that are muddy. Some customers use them for operating products and some use them as an investment product. And a good example is there are overnight transactional accounts, perhaps in Canada or other jurisdictions with a fairly high rate. And do you need to clean up your deposits and tell customers this deposit type is only for operating services, and in fact the rate behavior and the rates offered are going to drive that, versus these products are for your investment activity. The purpose of the deposit has to be used for operational activities. So the regulators want to see things like payroll disbursements, customer collections. And so how do you prove that there are operating cash flows going in and out of this account? If you're a bank that has not appropriately cross-sold your customer base, and maybe you're sort of a legacy model where the RMs told the client, hey, you're giving us credit, you need to open up this DDA, that is going to be an empty account that is not going to qualify for operational purposes. And that is going to just intensify the focus on becoming the primary bank and on cross-selling the client. The economic incentive, you can't give incentives for the clients to leave excess funds in the operating account. So there's almost this sort of Eden-like quality where the account magically has money that's only needed for operating purposes. Well, as we know, clients don't manage their balances that way. They mingle balances held for reserve, rainy day cash with operating cash. And as you can see with this excess funds category, there's going to be a need for a bank to discriminate the balances that are used for operating purposes from those that are excess. And what the regulators are going to require is empirical proof. So again, that's another area of interpretation. What comprises sufficient empirical proof to prove that some level of balances in each of those accounts is used purely for operating purposes and not other types? One of the most just sort of frightening aspects of this rule is the customer type. It doesn't matter if it is an operating account, if it's for an investment company, a non-regulated fund, or an investment advisor. Well, the investment company refers to the SEC Act of 1940 for the Fed's guidance, and that includes a $1 trillion industry that has mutual funds, investment advisors, and you've got to ask yourself, basically, we understand kind of the idea that there's systemic risk within the financial system with those deposits, but in essence, the regulator is taking a whole swath of customers and saying, we don't care how their operating accounts are structured, those deposits are volatile and don't add value. Who cares if it's segregated funds of retail brokerage clients versus money that can be quickly moved about for speculative purposes? It all gets sort of lumped into the same category. And then there's a rather technical issue around FI deposits, around offsetting correspondent accounts that are held in temporary overnight funds. So again, at best, there's a lot of technical interpretation that has to take place. At worst, there is a lot of contractual product structure and modeling changes that have to take place just to prove that you qualify under these rules. And essentially, this is guilty until proven innocent. So if you cannot actually prove empirically, statistically, that these rules are met, you're going to be deemed to have a non-operational deposit, and again, a much higher runoff rate, much higher liquidity costs for the bank. Okay. So in terms of dissecting the regulation, we've covered some of these, but want to hit on some of the points that we're currently working with our clients on diagnosing, trying to put some technical detail around this and begin to think about a response. The first is, what constitutes significant volatility and how do you measure it? There are a lot of ALM type of work or finance work to say, is this a volatile or non-volatile deposit? In the last literally 9 months, Treasury Strategies has radically redone its deposit modeling programs. And what we've found in general is that the legacy approaches to modeling deposits were overly simplistic. They did not give a good sense of significant volatility or even a good description of the customer behavior, both in a steady state environment, but also under a stress scenario. So the significant volatility, what are the parameters, how do you model it, at what threshold do you say that this is significant? That's all something that a bank is going to have to put a stake in the ground and then get second-guessed by regulators as to whether or not they've got the right approach. This issue of excess funds, what constitutes excess funds? Companies might manage their operating accounts with more or less accuracy based on their ability to position cash and manage it aggressively. How is a bank really to make that distinction that this is an operating balance with payroll, disbursements, collections running through it, and this is an excess fund? Again, that's going to require some kind of systematic quantitative measure, and that's going to have a rationale that satisfies the regulators. Thirdly, do I have to change my product structure and or my contract language to ensure that my deposits are operational? We talked about this again. There's some real messiness in how some banks have structured their deposit products. There may be contract language that could be seen as calling into question a bank satisfying one of the 8 rules. And there's going to need to be a review of that to ensure that you have very clean product definitions and that those definitions qualify the deposit as an operating deposit. Again, for a term deposit, what's a significant penalty? A significant penalty for a retail client might be very different than one for a middle market client, and might be very different for one for a large money center client that's investing in the wholesale markets. Again, that is going to require a very technical interpretation by the bank, an ability to operationalize that and how it classifies the deposits, and then an ability to justify that to the regulator. And then we could also ask what qualifies as an economic incentive to hold excess funds. At some level, does earnings credit rate offer an economic incentive to hold excess funds, or are there other quid pro quo arrangements? And this could even get into how your sales force is marketing the deposits. What if you have a perfectly structured product strategy to not incent excess funds, but salespeople are sort of informally encouraging clients to hold excess funds? So it's not just a matter of a narrow group of people that have to manage this, but this is going to extend out into your sales force, your marketing, all the way through the bank. It's just a very large undertaking to qualify and operate under this regulation. I'm going to turn over to Kathy now, and I told Kathy she gets the fun issues. I get the technical issues. She gets the strategic issues.
So as wrapping up our dissection of the regulation for the moment, yes, the strategic issues. One of the most interesting of which is a fairly straightforward one. Who in the bank is doing what? You think about this, is it a regulatory issue? Well, yes. Is it a business issue? Absolutely. Is it a balance sheet management issue? Absolutely. Well, as we all know, those are functions that touch 3 very different areas of the bank. Perhaps there are many more that are actually involved in this when you get the full analysis done. So the question is, how do you bring all of those groups together who have a very significant interest in this new regulation and the outcome of it for your organization? How do you bring them all together and work together to knit a coherent strategy and approach for your regulatory, your balance sheet, and your marketplace issues? As I think what Dave has been saying to you will give you the picture that there is a lot of analysis to be done, a lot of modeling, a lot of periodic measurement and reporting that will have to be instituted and made part of the fabric of the organization, lots of business decisions that have to be made and will have to be managed and modified until the new equilibria are met. So everybody's got to take some of these roles and responsibilities, and pulling them all together, again, for this cohesive approach is going to be a very big challenge. And all I'm doing right now is putting that out there. I'm not telling you how it's going to get done, just that it has to be done. Another good strategic question, more from a business point of view, I think, is this issue of attractive versus unattractive deposits. There are obviously big implications for the credit side of the organization when you start thinking that some of your customers may generically be producing unattractive deposits. I mean, in a lot of organizations, those deposits and the associated business that they support are what's really paid for the relationships, not the credit. And yet, if we reach a stage where we're saying some types of organizations generate deposits that I cannot count for one particular regulatory purpose or another, and they are unattractive, then that really changes the dynamics and the equilibrium of those types of relationships. Obviously, there are going to be lots of operational business-type strategies that need to be considered. Your rate strategies, the types of clients that you focus on, the actual positioning that you're making in the marketplace with customers. How do how you're going to talk to customers about the value of their deposits now when, for all intents and purposes, every customer you have has grown up thinking that where they put their deposits is very significant and important to their bank relationships, and it's the part of the plum of the relationship. Well, maybe not so much any longer. So changing all of those strategies and positioning and structures is certainly a tremendous amount to think about. For the curious among us, those certain types of companies that Dave mentioned, where there is a lot of volatility and systemic risk, where what our regulators may be saying that their deposits simply are not to be counted as part of your stable deposit base, who's going to bank those kind of organizations? You've just got through a stage where we're dealing with deposits from the public sector and deposits from segregated funds types of businesses. Many banks have just gone through their portfolios and done kind of a cleansing on those counts. Do we have to do this again for investment companies and investment advisors? Don't know that yet. And obviously, at the end of the day, how clients and competitors respond is going to be key to your secondary and tertiary strategy adjustments. So having dissected the regulation then, at the level it's possible to dissect in a 30-minute webinar, let's turn now to some of the preparation you'll want to be considering as you start to grapple this to the ground.
Okay, thanks, Kathy. And what we're outlining here is sort of the process that a deposit business has to go through to get ready for Basel III. And obviously this is a dynamic, evolving process. And as we get more clarity from the regulators, some of these steps become clearer. Right now, some of these steps, quite frankly, are sort of a range of outcomes that our clients are preparing for. So what we've laid out here is a readiness program that we actually execute on behalf of our banking clients. Obviously, some of our clients do many of these activities in-house. Others may come and look for advisory support on all aspects of it. But really, we see sort of 4 stages. One is the interpretation, so just kind of putting down what does this technically mean. Let's get serious about the mechanics of this. The second is the diagnostic. Now that we've applied this, what are the outcomes? What's attractive? What's unattractive? How do I feel about my clients, my products, my market segments? That leads to a strategy. The strategy can be both a business strategy, but also an internal strategy to effectively comply and optimize within the regulations. And then obviously the execution. And as we've noted, this is going to involve salespeople, marketing, product, finance, ALM, on and on and on. So it's a rather large program. In terms of the interpretation, some of the key things are really isolating what is known and unknown. And what's unknown is going to be something where you're going to have to really document your thinking and look for regulatory approval. There's also an opportunity to advocate with the regulators. So, clearly the regulators have not locked down all aspects of the regulation. They're not always the most open to suggestions, but they are interested in strengthening the systemic ability of the system and pointing out things that do that are a win-win for banks, corporations, the regulators, the banking system, can help them make better decisions. And then I think there's benchmarking. One of the things that we're just getting a ton of questions from our clients on is, what am I doing that's different than everyone else? What is everyone else doing that I should be doing? So we've become somewhat of a clearinghouse for best practices among banks in interpreting and responding to the Basel III regulations. In terms of the diagnostic, there's scenario development, modeling of the portfolios, but then this secondary analysis of the output. If I do come up short for the liquidity coverage ratio, or even if I clear it, what does that tell me about my portfolio? What looks good in my portfolio? What's a gap? How much of my gap can I really take on and still be able to have an attractive business? And then there's the modeling of the competitor and client responses, because the biggest challenge we see with our bank clients is they tend to do a model and say, the output is Y, now we're going to do this and this will be our strategy. Well, that would be great if your customers just did exactly what you want them to do, but they don't. And your competitors don't sit still either. So there needs to be almost a kind of game theory mapping out of the responses to understand what kind of equilibrium are we going to get to, what kind of chaotic stage might we see in the beginning, and what's the best way for my organization to navigate that. In terms of strategy, there are so many levers here. It's almost daunting. Product structure, price and rates, target market, target client. Modeling out those options, finding options that align to your value proposition, that align to your base strategy that you can deploy are critical. And then this is an area where strategy has to be dynamic, because the regulators have not locked down the regulation, and there's still a lot of customer-competitor shakeout here. So, you know, any bank that thinks it's going to hard bake a strategy and execute it, you're kidding yourself. You definitely need to have the flexibility to take in the market response and dynamically adjust your strategy over time. And I do think it's critical that you sense check your strategy. Am I an outlier? Because if a bank interprets it differently than other banks, you better have a very good justification for that for two reasons. One, the regulators are almost steering everyone into the same economic profit model. So the minute you step out of that profit model, you're going to be flooded with business that if you say that something's more valuable than everyone else, because you're basically going to create a market clearing point that no one else has. So, you know, a bank that figures out how to do operational deposits for investment companies, good luck. You're going to have every single deposit from that sector, whether you're ready for it or not. By the same token, if you have an outlier position and you look too punitively on a segment, you could lose all your business in that segment. It could be highly attractive for you. So you really need to find out where your interpretation and your strategy is different than the market. It's not to say that shouldn't be the case, but you better risk and stress test that before you act upon it. I won't go into the execution other than to say massive change management, massive communication, lots of governance, the need to have an iterative strategy with a lot of feedback, and that's going to require a lot of thought put in place into the execution. And as you can see, we're not far from this becoming a real impact on the bank, its financial reporting, its ability to operate unfettered by regulatory sanction. And as a result, there's a lot of work to do starting now.
Okay, we did a quick survey to help us prepare for the webinar today, and I just want to share a couple of data points from that very quickly here. One of the questions we asked our 620 respondents was just the question about who's taking the lead in all of this organizationally. And as you can see from this chart, about 2/3 of the respondents say that either Treasury, ALCO, or Finance is taking the lead, implying that in 2/3 of the cases, it's primarily being considered a balance sheet or accounting regulatory driven issue. Now, what that says to us, obviously we've already said there are numerous parties that have a stake in the game here, so many people have to have a seat at the table and be actively participating. The lines of business in particular, given that in so many cases they are not leading the charge here, need to make sure that they're involved in crafting this finely orchestrated dance among the internal parties. And the second data point I classify as falling into the category of misery loves company. We ask people to assess their level of readiness, their level of preparedness across 4 different Basel III measures. And I'm only going to talk about the LCR here, but we show the other 3 measures as well. So were they unprepared? Not prepared because they don't need to prepare, it's unnecessary. They're not very prepared, but they plan to get there. Did they say, yes, I'm somewhat prepared and I need to make improvements to it still, but I've got some action underway? Did I say yes, and my level of preparedness is quite credible? Or were they simply unsure? Those are the choices that we had. And as you can see under the LCR stacked bar there, a very few companies said, respondents said that it was unnecessary. And we were surprised by this because the only people who really would find it unnecessary to prepare for this would be either very small institutions that didn't think they were going to grow. So got to question that a little bit. Somewhere around 25% said, no, I haven't started to prepare yet, but I know I've got to get going. Right around 30% said, we've done something, we are somewhat on the ball here, but we have a ways to go. And to our way of thinking, this is the really rational spot to be in, to have started some work, started some measurement and assessment, but obviously it can't be too far along because we're just starting to get the directives handed down. And how much could you have figured out without knowing how the regulators are really going to regulate? We had about 20% who said, yes, we've done a lot of work, we're prepared, and our preparation is quite credible. Those people, we have a little question mark in our minds about how can you be really prepared and credible when we don't really know what target we're aiming at, or when we just found out about 10 days ago in some cases. And the unsure group, we think is a reflection of the fact that, again, at many organizations there are so many players involved. It may be that there are several disparate efforts going on that haven't been knit together yet. So, you know, I'm not really sure who's leading the charge. Maybe it's not being led. Anyway, like I said, misery loves company. Any of you who are in the blues or the greens needing help or the unsures, the plan that Dave just outlined is the plan that we're taking our customers through, so we'll be happy to talk to you about it if you need external assistance in this. All right, and as promised, we're going to turn to Q&A, and we have lots of questions that have come in during the talking part, so let's get to some of those.
And we thought we'd have sort of a peaceful, beautiful backdrop because regulation can be stressful and painful, so we thought this might be nice. There's this one question I love that I saw right away, which was, I need to find it now. Given the limited liquidity coverage ratio for smaller banks, do the agencies intend to have depositors move non-operational cash to these banks, or do you think this is an unintended consequence? And I love this question because it points out that one of the main things with regulation is the unintended consequences. And I don't think it was an intended consequence. There just aren't enough small banks to house these deposits anyway. But you are going to see the largest banks that are seen as the most stable, that attract operating cash, not having a need for the non-operational cash. And that's going to raise the question of where does it go? Well, it could go into mutual funds. The regulators are busy trying to destroy the fund industry, so good luck with that. There's going to be all kinds of new vehicles we think that are going to have to take this non-operational cash because it's going to be punitive on many banks' balance sheets. But maybe what you could do is you could kind of create a federation of billions of tiny banks that could take on non-operational deposits and serve the market. But quite frankly, there just isn't enough capacity among those banks to house it. We have a question that's a technical one here that says, given that a company can concentrate operational accounts in interconnected structures via a zero balance account feature, will regulators look at accounts on an individual basis or at the top concentrator level that captures all accounts? There's not necessarily clear guidance on this, but our interpretation would be if you are really looking at the behavior of the corporation, you're going to want to look at that holistically at a relationship level, meaning at an entity level that is organizing the cash flows and managing the cash. And for that reason, in the modeling work we've been doing with our clients, we've tended to do the modeling at a relationship level. I do think it's useful to look at the account level for some of the more technical aspects of the regulation, but in terms of the modeling, our approach would be to look at that relationship level. Okay. One of the questions, I may paraphrase this, but it's a question of whether the regulators will be open to kind of a group liquidity coverage ratio for a banking group instead of having the bank comply with multiple local independent liquidity coverage ratios. And this individual is asking, as far as they know, there's still some discussion going on group and local liquidity coverage ratios, net stable funding ratios. And actually, you could take this beyond the deposit work, group leverage ratios. I think there's sort of two potential things that could happen to make things easier for what I'll call a bank working in multiple jurisdictions. The first would be some normalization and alignment of the regulatory interpretation. And we're not seeing that yet, but that would obviously be a huge benefit because it would take a bank like, a Bank of America or other large global bank and just make it operationally simpler and clearer for them to comply with the regulations. The second would be something where you would really look at a group liquidity coverage ratio. That's been talked about. I can't see it happening. And the reason I don't see it happening, and I might happily be proven wrong, I cannot see the EU saying, this bank is headquartered in the U.S., therefore we're going to collaborate with the Fed and look at a group liquidity coverage ratio. The other thing that we've seen is that the regulators have viewed the need in a crisis and a stress situation to look at a single currency level, to look at a single country level, and to really look at this breakdown of systems. So it would be great that on a real basis, a bank might be able to manage its dollar book or its euro or yen book across multiple offshore or other jurisdictions, and then manage the LCR in an aggregate manner. We just don't see the regulators permitting that, both because of their view of the stress scenario and secondarily because they're not going to want to cede any control or even dynamic collaboration to other regulatory bodies.
Still, it would be a benefit if, even though the measurements weren't allowed to be consolidated, the processes were more similar than dissimilar. So you could use the same process. And, we're in the early stages of seeing how the regulators will do that, but there does seem to be some hope that those might look quite similar in some cases.
We have a great question here, which is, what are the different deposit purposes? And I love this question because there's a tendency to try to create deposit purposes that are sort of bank specific. This is an operating account. This is a term account. But if you think about Basel, and I'm going to step aside from the technical interpretation and more the spirit of the regulation. The spirit of the regulation, which makes a lot of sense to us, is looking at that customer behavior and modeling that behavior as a basis for understanding liquidity risk. And we actually think that the strongest methodology is one that could align the asset liability management group's requirements with the regulatory requirements, with the business requirements. And for that, we would start with how the customers see their deposit purpose. And one of the things we've done at Treasury Strategies is we've segmented corporate cash into 4 buckets. And the first is what we call operating cash, which is nice. It aligns with Basel III. And those are the frictional balances that a company maintains to not only settle and collect funds, but they do leave a cushion in there to allow for some of the volatility in their day-to-day cash flow. So that's the operating balances. That's squarely within the operational deposit definition of Basel III, highly valuable. We then see companies hold what we call reserve cash. This is excess cash, and you might think of this as excess funds. They don't need them for the day-to-day operations, but they're keeping them in the event of a crisis or other risk event, so they have access to cash. We also see what we call accumulation cash. That might be a high-tech firm holding money, getting ready for some kind of capital expenditure acquisition. It could be money accumulated for a bond sinking fund, any number of things. That tends to be more structural cash that can be invested in a term product. And then the last is what we call regulatory cash. That could be segregated funds, title escrow money, where the main behavior of the client is to put that money in a structure that complies with regulation. That's actually a really interesting bucket because traditionally it's been fairly stable, having some macro changes with the nature of that sector, but there is a way under Basel that those deposits might be deemed less attractive. And I think that's one of the areas where banks are going to really have to advocate to take care of their clients. So I know we're at the end of the webinar. There are a slew of questions that we did not answer, and we will try to pull those together in a written response that we'll share with you. We want to thank everyone for attending the webinar. We want to thank you as well for the very thoughtful and thought-provoking questions.
Thank you for joining us today. And as I said earlier, we'll have a link to the audio recording of this session as well as the slides out to you within 2 days and answers to the questions. We'll answer them all, even though we'll just repeat the ones that we answered verbally here. Again, thanks for joining us. Bye-bye.